Today we are going to focus on the cash flow statement. What is a cash flow statement? The cash flow statement deals with the flow of cash. So the cash flow statement deals with the flow of cash. So deals with the flow of cash. So the cash flow is separated into three parts. The first one is the cash flow from operating activities. So the cash flow from operating activities it involves the buying and selling of the inventory, um, when we are receiving money from our debtors, when we are paying our creditors, and also when we are paying um, the expenses of the business. So let's look at the inflow of cash from the operating activities. The first one, so is the money received from sales when the business is selling the goods. The next one, money received from other income. For example, commission income and rent income. And then the outflow of cash. This is the money paid for the expenses, paying for the water and electricity, paying for the insurance, and so on. The next one, money paid for the trading stock. When the business is buying the trading stock, so there is going to be an outflow of cash because the business is spending money. And then money paid for dividend. So this one, this dividend we're talking about the interim dividend and also the final dividend of the previous year. Remember, for this one, we are talking about the final dividend of the previous year. And then money paid for tax. So we're going to get to this one. And then let's continue. Number two. So number two is going to be cash flow from investing activities. So when I'm talking about the cash flow from investing activities, um, we are talking about the buying and selling of the fixed asset, um, or also when the fixed deposit is maturing. Okay, let's look at the outflow of cash. So here we are buying the assets, that is an outflow of cash because the business is spending the money. When we are replacing the asset, also still we are spending the money. And then we have the inflow of cash. So here, this is where we are selling the fixed asset. We are selling the car, we are selling the land and building, and so on. So if you are selling, it means that you are going to receive money. It is an inflow of cash. And then fixed deposit maturing. Remember, when the fixed deposit is maturing, so we need to receive it back to the business. Then the third one, because I said the cash flow is separated into three parts. So the third one is the cash flow from financing activities. So when we're talking about the cash flow from financing activities, for example, we are talking about when the business goes to the bank and then asks for a loan. So when the business obtains the loan, that is a cash flow from financing activities. When the business pays off the loan, when the business is issuing the shares. Okay, let's look at the inflow of cash. Money received from the issuing of shares. So when the business issues the shares, the business receives the money. Money received from obtaining a loan. The business goes to the bank and then asks for a loan. So obviously you are going to receive the money. And then the outflow of cash. money used to repay the loan, or it can be when the business is investing in the fixed deposit. So obviously the business will be losing some money. And then the next one. So here we are going to look at the note to the cash flow, because the cash flow has the notes. So this is the first one that we're going to look at. This is the cash generated by operation. So the first one is the profit before tax. Profit before tax. And then we add back that depreciation. Remember, when we are doing the income statement, we are subtracting the depreciation. But because the cash flow deals with the flow of cash, we need to add back this depreciation. So we add the depreciation, and then also we add the interest expense. Why? Because the interest expense in the cash flow statement has its own column. So this is why we are adding it back. And then also we are separating the income, interest income. Why? Because the interest income has its own column in the cash flow. Remember, in the income statement, these two, the interest expense and the interest income. In the income statement, we are subtracting the interest expense, and then we are adding the income, interest income. So what we are doing here is we are reversing this. So what we are doing here is we are reversing this. Because we subtracted the interest expense, now we are adding it, because under under cash flow, we do have the interest expense column and also the interest income. And then we have the changes in working capital. So if there's an increase in trading stock, so maybe it's because we bought the trading stock. So obviously, the business is losing money. So if the business is losing money, we have to put that in brackets. So if the business is losing money, we have to put that in brackets. A decrease of debtors. So if there's a decrease in debtors, it means that our debtors, they are paying us. So we don't have to put the brackets. And then the decrease in creditors. So if our creditors control are decreasing, it means that the business is paying its creditors. So meaning this, there is an outflow of cash. So when there is an outflow of cash, we need to show that in brackets. Let's go to another one. Let's go to another one. The other one is the dividend paid. So to get the dividend paid, we're going to say find dividend from the previous year. So under balance sheet is written as the shareholders for dividend plus the interim dividend from the current year. Then you get the dividend paid. And then other one as the tax. So the other one is the taxation paid. So you take the money from the income statement, the income tax from the income statement, then you add it with the SARS income tax, from the balance sheet, because most of the time it's there in the balance sheet. So you only add it if that SARS income tax has a credit balance. You only add it if that SARS income tax has a credit balance. But if it had a debit balance, you are going to subtract it. And then you add the balance at the end of our financial year. The balance at the end of the financial year, this is a SARS income tax at the end of the year. So you only add it if the SARS income tax has a debit balance. You only add this if the SARS income tax has a debit balance. But if it has a credit balance, you subtract it. Then at the end, you get the taxation paid. So let's go to what you are here to do. So we are told to prepare the ordinary share capital on 28 February 2021. On 1 March 2020, at the beginning of the year, because our years end on 28 February 2021. So this is the beginning of the year. So at the beginning of the year, we had the shares of 800,000. So let's go and check our ordinary share capital. So at the beginning of the year, the ordinary share capital is 6,400,000. Why are we saying the opening part at the beginning of the year, the ordinary share capital is 6 million? It's because here it's written 29 February 2020, meaning that when we start on 1 March 2020, this is going to be our opening balance. So it's 6,400,000. And then we have the buyback of shares. So we have the buyback of shares of 30,000. So 800 plus 900, 800 plus 100 is minus 30 is equal to 870. Now, this is our buyback. So it's going to be 30,000 times the average. So to get the average, we're going to say 7,395,000 divided by 870. So the average is 8 rand cent. So 30,000 times 8 rand 5 cent. The answer is 255,000. Now to get the new shares issued, we're going to say we're going to do the reverse, because to get this one, we said this one 6 million plus new shares minus buyback, then you get the shares at the end. So we're going to do it in reverse. We're going to say 7,395,000 plus 255 minus 6,400,000. So our answer is 1,210,050. So remember, to get the shares at the end, we say balance at the beginning plus new shares issued minus the buyback, then you get the shares at the end of the year. So that is why we added this 255. Then we subtracted this because we were reversing this. So we also call this as the shares repurchased. the buyback shares. And then now let's go to our cash flow. So in our cash flow, we have the dividend paid. So remember, I said you take the interim. The interim is 162. So to get the dividend paid, you say interim dividend plus the final dividend of the previous year. So 162,000. So I said in the balance sheet, it is shown as the shareholders for dividend. But sometimes you might be asked to calculate it. So this is our shareholders for dividend. So this is our final dividend for this year, and then the final dividend of the previous year. So it's 150,000. 115,300. And then, so to get the money, you say, 162,000 162,000 plus 115, 300, it is 277,300. And then you go to tax paid. You take the tax that is in the income statement, the income tax. So here we are given the net profit before tax and the net profit after tax. So to get the income tax, we need to find the difference. We need to find the difference. We need to find the difference. So minus 985,500. Then, so this is our income tax. 264,500. Plus SARS income tax. I said we only add it. So because I said you say the income tax from the balance sheet, I mean from the income statement, plus the SARS income tax, the closing balance of the previous year. We add it if it has a credit balance. But if it has a debit balance, we subtract it. So plus 35,900. And then we add the SARS income tax of our current of the closing balance of our current year. I said we only add it if it has a debit balance, the closing balance of our current year. But if our closing balance of the current year has a credit balance, we subtract it. So plus 29,100. So it's going to be 364,500 plus 35,900 plus 29,100. So the answer is 429,500. So because the business was paying, meaning that there is an outflow of cash, we have to show it in brackets. And then cash flow from financing activities. So we have the shares issued, How much were the shares issued? It's the shares issued, the new shares issued, it's 1,250,000. 1,250,000. Then we have the buyback. So the buyback is 255. 255 plus, because we have the one that is going to the retained income, so we also have to add it. So it's 120. So 30,000 times 120, the answer is 36,000 plus 36,000. So the answer is 291. The answer is 291,000. And then let's go and check the loan. The loan decreased from 2,200,000 to 1 million. So meaning that the business paid the loan. The loan, it was 2,200,000 in 2020. Then 2021 it decreased to 1,600,000. So this means that the business repaid the loan. On 2020 it was 2,200,000. 2021 1,650,000. So what is the answer? So to show that the business was buying, there's an outflow of cash. You have to show this in brackets. So how much was paid here? Minus 1,650,000. So it's 550. So this is the money that we paid. Now let's get the cash flow from investing activities. 1,250,000 minus 291 minus 550. The answer is 409,000. Now, to get the net change, we are going to say 1,180,000 minus 1,220,000 plus 409,000. The answer is 269,000. 269,000. Then we have the cash and cash equivalent at the beginning of the year. So let's look at our cash and cash. So the petty cash at the beginning, it is 20,000. And then also we have the bank overdraft. So because the bank overdraft have a negative balance, we have to subtract it. Minus 95,200. So 20,000 minus 95,200. So the answer is 75,200. And